ones who do more than defy rules, they change them. This is for the followers. Right now, lease the first ever BMW X2 for as low as $399 a month.
Hablo español.
Y Spanglish.
Hazlo con pila.
We love to dance. Bailemos por.
Muévelo, que tiene el azúcar abajo. I love to hug. We love squeezing people. ¡Huepa!
We tell the strangers.
The more the merrier.
LA.
With un RSVP.
I love to cook, but to eat, that's much better.
Pura vida. We love food.
Qué bacán.
I am a proud Latino.
To be a Latina.
Eso de ser Latino. In New York, Latinos are the one.
When I'm running, I think about how my story is going to evolve. We all have problems that need to be heard. That is my role here at New York One, is listening to someone who may never have been listened to before. There are many sides and faces to the homeless crisis in New York. It's a difficult story to tell, and it's something we do at New York One all the time. I'm not someone who gives up very easily. I just don't take no for an answer. I'm Courtney Cruz, political reporter, New York One.
Stock market futures pointing to a higher opening this morning. Investors hoping that things will bounce back from Friday's losses. Matt McClure here with that morning. Our Money on One report. Hi, Matt.
Hi, Louis Rockville. Good morning to you, and hoping it will be a good morning for the markets as well. Stocks fell on Friday, but the markets have actually posted gains in 2 out of the last 3 weeks. Let's take a look at the numbers from Friday. Bank stocks up. We tape and leave no waste. We've been able to remedy any questions about cleanliness by purchasing a washer. It's guaranteed a clean bundle box every time. So whether you're a residential, commercial, or corporate client, Bundle Box will service your needs. Bundle Box. Move, unpack, and give them back.
After my motorcycle accident, Salino and Barnes got me $1.5 million, 12 times more than insurance offered.
They got me over $600,000, 9 times more than insurance offered.
The real conviction stock, Bank America, because it's a very attractively priced amongst the largest banks, followed by Citigroup and then JP Morgan. All three of them should do well throughout the year if the trends we saw this quarter continue based upon the rise in rates and the stronger U.S. economy.
Stephen, isn't this a consensus view on this stock, and do you worry that it's a bit of a consensus view?
So I think on the rate side, it is a consensus view with regards to U.S. domestic gearing, higher rate sensitivity at B of A. But I still believe that if you look at numbers, the lower deposit beta and the route to surprise positively on NII is underappreciated. And it's really the expense and credit stories where we actually see the most upside potential. I would agree that both JP and Citi are relatively cheap. The difference is there is no positive revision story there. Whereas you look at B of A and the potential to surprise positively, not just on NII, which I think is better understood, but expense and credit as well, I think is going to drive continued outperformance. I mean, this is a company that...
Okay, it's April 16th, 2018. It took me a few minutes to get everything ready. Usually when this happens, I'm just getting out of bed and not dressed, so that's why I'm not including myself in pictures of this early in the morning. But anyway, even before I started recording, about half an hour, like I said, it's 9:21, about a half an hour ago, it started smelling the smoke coming through, even though the windows were shut. The smell came through, and I just got out of bed. I had to use the bathroom and try to get a little bit ready. So anyway, once again, it's April 16th, Monday, April 16th, 2018, 9:21 a.m. We're looking out of the windows of 255 West 43rd Street, looking direction northwest at the twin chimneys operated by John's Pizzeria, and their entrance available for the public is at 260 West 44th Street. And the reason I say that's their public entrance, I don't know if they have another entrance for their employees, but that's the entrance when we have gone there and protested. So guess this is located in Manhattan. It says on John's Pizzeria on their website that their ovens are over 800 degrees Fahrenheit, and that's why the smoke is so toxic, because you can Google it. Any report from any hospital, university, any university report, and usually it's a university-based hospital, states clearly that food is very toxic when it's cooked that hot. You shouldn't eat food that's cooked that hot. It's bad for you. And also, you see that's why the smoke is so toxic, because it's done at such a high heat. And let's see, I'm going to get my cell phone out and just to confirm that I'm recording the same time it's the camera, this camera is. Okay, it's a rainy day, as you can see. It's April 16th, Monday, April 16th, 2018. And now it's 9:25 a.m. And let me zoom out on this is the Nikon camera that we're recording from the Apple iPhone X. We're recording my Nikon camera, and we're just going to say this is my some books here, and go over to the TV. Turn on the sound. Okay, that's enough.
Crude lower too by 0.75% to $66.88 as we start to remove some of that geopolitical risk premium back out of the commodity market just by a touch. In the FX market, a much weaker dollar here in the G10 space. We add to some of that as the president starts tweeting about currencies again. 123.88 is where we trade on euro dollar, up by about 0.5%. With me around the table is Chris Harvey of Wells Fargo, Ian Lingen of BMO, and Gina Martin Adams of Bloomberg Intelligence. And Chris Harvey, you've made this point, and I want to sort of elaborate on it. We had the tax bill, and almost people expecting to instantly see all of these results in the equity market and just see it programmed from the tax bill into the bottom line, and for it to happen like that. It's not happening like that.
It doesn't happen like that. The tax bill happened faster than I expected. I think it happened faster than most people in the C-suite expected. You have to plan. Then everyone's on vacation. So then you have to go and plan. How are we going to spend it? Where are we going to spend it? And then once you decide where you're going to spend it, then you actually have to go and spend it. That takes time. And so I think a lot of what we're seeing when people see weaker economic numbers or some weaker data, it's really about the lag. It's not the economy slowing down. It's taking a while for that to flow through the system.
Well, let's do that relative to earnings. JP Morgan delivered record profits, record revenue on Friday, and then the stock closes down by 2.7%. Does that make sense?
So banks, and I use this phrase often, they're more of a George Costanza. Often when things are good, they underperform. When things are bad, they outperform. But later on, just the knee-jerk reaction, it is a reversal of what you would expect. But as we go forward, I expect banks to outperform. When you look at banks, the risk profile is very attractive. The capital give-back story is attractive. As we've been talking about before, volatility is back. And the fundamentals are quite strong, are good to quite strong.
The optimism in financials, though, is still really elevated, Gina, and I wonder whether that was the signal that came out of the price action on Friday.
Well, there's just great expectations. I mean, this is the biggest consensus long. Everyone wants this sector to work really well, so they're positioned for this sector to work really well. And frankly, if you look at expectations as they've changed over the course of the year, the earnings lines have moved higher, but the sales lines have been somewhat stuck. And without really strong optimism on the calls, investors were somewhat frustrated. I think you've got to have more optimism on the calls. And to Chris's point, investors are really hungry for deployment of this capital. They are incredibly hungry for it. We run an earnings transcript analyzer every quarter through the earnings season, and we look for the frequency of notes on calls. And the analysts consistently, especially for financials, asked about capital return. What are you going to do? How are you going to do about your buyback? What are you going to do about your dividend? Is it going to continue? If you think about where we came from last year, this was a big source of optimism for the sector. It led return of capital on the index. That needs to continue into this year and probably accelerate for this sector really to work.
Well, if you look at what's coming out of Bank of America today, it's cost cuts, cost cuts, cost cuts. It doesn't look like this money is going into investment. A little bit for technology maybe, but the majority, you would assume, is going to buybacks and dividends.
We hope, but we haven't seen the announcements yet. I mean, this is part of the problem. It's like you've got all this cash, earnings are growing so rapidly. What are you going to do with this cash? And to Chris's point, they don't necessarily have that quick of a planning process, right? They've got to methodically go through the process of absorbing the gain from tax cuts, figuring out where the most appropriate place to deploy that capital is going to be. And investors, especially equity investors, really got the month of January priced in extraordinary expectations for this tax reform. And so we're just really hungry for detail. And the companies have been slow to provide that detail, and that's created a bit of friction in the market.
Let's cross over to Bloomberg's Taylor Riggs, shall we, who has been listening to the Bank of America analyst call, and she joins us now. Taylor, what's the latest?
John, there's three key Q&A calls that I want to talk to you about. The first one was a Q&A on deposit pricing. That was from an analyst over at Buckingham Cunningham. He talked a lot about the bank's decision to keep that deposit pricing low, and when you start to see pressures build in the market. The CFO responded to that saying, look, the pressures in the market just aren't there, and we see that the bank delivers a lot of value outside just deposit pricing, so they don't see that ticking much higher anytime soon. There's also Q&A on the yield curve. We still can't escape yield curve questions. That was from an analyst over at Evercore talking about how flat it is. The CEO did, of course, come out and say, look, it'd be better if it were steeper. But John, as you know, is all about the roll yield. And he says that banks in a situation where current securities are rolling off, they're getting to reinvest at a higher yield. So, hey, that's still something. Finally, there was a third Q&A from Mike Mayo over at Wells Fargo, a lot on consumer banking. Now, John, the CFO and the CEO have both talked a lot about technology on the consumer banking side and digital payments. Here's a quote, a soundbite from the CFO speaking on digital payments.
Digital payments grew to $365 billion this quarter, well surpassing 50% total payments of $682 billion, which were up 10% year over year.
So, John, clearly digital payments have been a push for them, but they also said technology is allowing them to keep costs low, and there are still some customers still coming into branches, so don't count them out just yet.
Taylor Riggs, nice work. Ian Lincoln, just looking at the situation with the yield curve, flat, flat, flat. For these banks, it hasn't presented a challenge because they haven't had to pass these high rates on to deposits anyway. But do you anticipate that this is the trend now, flattening?
Yeah, I certainly see that a curve flattening is the path of least resistance. I actually think that we get the curve inverted by the end of the year. And an inverted curve is obviously not going to be great for financials, but it's also going to reflect the realities of where we are in the business cycle. We have a Fed that's continued to push forward with tightening at a time when the economic data is frankly good but not great, and where the expansion is certainly towards the end of its cycle.
Gina, within the bull case for the banks, there is this confidence that deposit betas are going to remain low. And this won't be a story for 2018. Do you take the other side of that?
I think it will be a story for 2018, probably into the second half of 2018 as competition increases. Amid this flattening yield curve, as rates go higher,
it's difficult for me to hold
landscape
this
changes a lot,
cell phone.
especially if you get an increase in
Still,
loans.
I've
So
got
if we do get the economic growth,
still
all
early in
tax
the morning
reform,
for me. I
you start to see an
gotta
increase
get
in loans.
ready
The competitive landscape is
for-
going to shift a little bit, and it's going to be a different
eat,
story.
So
breakfast
you're
at
going to have an
the
interest
Senior
margin
Center.
as a one-way trade, Chris, later this year. You need the volume of loans to pick up.
So I gotta turn off
Are
the
you
cell
seeing that in
phone.
the numbers we've seen so far?
We're not seeing that in the numbers so far, but that's what we expect. Again, as we were saying before, there is a lag to the tax effect, and we expect that lag. We expect the numbers to improve. We're watching and we're listening to 1Q earnings. We think they're exceptionally important. It's not so much the report, but it's the guidance. What are people doing with the money? And with unemployment at 4%, where are you going to put the money? In all likelihood, you have to do productivity enhancements, and that goes into technology, and that goes into reinvestment. So we expect to see that going forward.
7 minutes into the session here in New York, we do open higher by about 0.4%, up by about 0.5% on the Dow. I want to run you through some of the stock moves and cross over to Julie Hyman. Jules.
And I'm starting with one stock that is not moving higher. It's WPP, the UK-based advertising giant. Trades quite a bit in the U.S., so these are the U.S.-listed shares. Longtime CEO Martin Sorrell, who essentially built up the company through aggregation, is stepping down after 33 years at the helm over alleged financial malfeasance, although we don't know the exact details of that. He made over $300 million in the past 5 years as the highest paid executive in the UK, and did get some flack for that. There is now speculation about a potential breakup of the company, and certainly a lot of questions about what will happen next. Those shares trading down by 5%. We are also watching a company called Allegiant Travel, which is an airline. Those shares down 5%. It's a regional airline, and the shares had already fallen about 8% on Friday over the news that 60 Minutes would be doing an investigation into the company. Indeed, it did last night, and the shares are continuing their slide down an additional 4.5%. And that report on 60 Minutes did question the safety practices at Allegiant. Its fleet of 89 planes has an average age of 17.2 years. We'll be looking for continued comment from Allegiant itself. And then finally, getting back to the banks here, Bank of America is now very little changed as we sift through its earnings numbers. You can see the other banks are also not seeing much change. Of course, many of them had pretty steep slides on Friday. following in particular earnings from Wells Fargo. Wells on Friday was down 3.4%. You can see it's down another 0.7 in today's session, John.
Julie Hyman, nice work. Still with me, Chris Harvey, Ian Lincoln, and Gina Martin-Adams. And Gina, I want to touch on energy just briefly. The story of the last year, you and I have talked about it so many times. Crude's rallying. Energy equities are not. Then last week happened. Walk me through why last week was different.
It's actually the last month. Energy is the only sector in the S&P 500 that's up over the last month. And it's up by a remarkable more than 5%. So I think a couple of things happened. One, it was the consensus short. Everybody hates energy stocks. I mean, I don't meet a single investor that loves energy these days, except for some short-term investors that wanted to play inflation expectations. But also, crude prices rallied and surpassed their January peaks last week. So that was a big boost to the energy sector, which is certainly the most benefit, or the biggest benefit of, or beneficiary of higher oil prices. And oil prices have been on a surprising uptrend for the last 9 months. They've been consistently making new highs, really contrary to anybody's expectations. I think the important thing is now supply and demand. I think everyone thinks that the rally in energy stocks is based on supply concerns and geopolitics.
Yeah.
But if you look at the longer term charts, you see that implied demand has also been accelerating for more than 6 months. And if that sustains itself, if you get a recovery in economic growth, this could be a big sector surprise for most accounts this year.
And a lot of people going into 2018, Chris, pitched this as the classic late cycle sector. Get into energy.
They have, and to Gina's point, what we're seeing is sentiment around the space is horrific. Now you had Brent through 70, so that catches people's attention. In addition to that, you had tension in the Middle East start to, for lack of a better phrase, skyrocket, and that boosted prices. But when we look at it, it's a difficult space for us because clients just don't care about it anymore. And clients have been burned by the space so much, they've decided, okay, I'm going to other places where the fundamentals are working, where the stocks are working, and that's where I'm going to spend my time.
Is that what you would advise them to do? Even if they don't care about it right now, what would you advise them to do?
We're spending a lot, so I don't know the answer to that just yet. We're spending a lot of time trying to figure out what to do. Is this a great contrarian call going forward? We don't know. We're delving into balance sheets, we're delving into the numbers, we're delving into the macro. But there's a lot there. You have to understand the macro and the micro. And so it's going to take us some time to figure this out.
I guess, Gina, you've also got to have the conviction to believe that this will last.
Yeah.
This sort of sentiment turn of last week, driven by geopolitical concerns, that the fundamentals are there to have Brent with a floor, line in the sand of $70 and WTI with a line of the sand of 65 and some support there.
Yeah, and investors don't believe it. I mean, energy absolutely has the biggest sentiment problem in the index if you look across the sectors, because if you look at earnings revisions and sales revisions on the index, energy has led those over the last 3 months. It's been the sector that actually shows the strongest fundamental upside. And yet investors are denying that because they just literally don't believe it. They don't believe that oil prices can stay high. They think that the U.S. is going to continue to flood supply on the market. As a fun fact for you, the energy sector market cap as a share of the S&P 500 today, with oil prices 65 plus, is half of what it was when oil prices were $10 in 1998. I mean, that is just how completely obliterated this sector has gotten. It is almost a non-event in the S&P 500. No one wants to touch this sector.
So maybe that's the reason to perhaps touch it. I don't know if that's the takeaway from this panel. Gina Martin-Adams of Bloomberg Intelligence, Ian Lincoln of BMO. Thank you, and to Chris Harvey of Wells Fargo. He'll be sticking with us. Coming up on the program, we'll run you through some of the earnings you need still to look ahead to. In a market about 12 minutes into the session, up a third of 1%.